Thanks for being here, Cardinal Hill Wealth Management. We're the best at what we do, minus tech.
It's fair.
But looking forward to just giving kind of a high-level view on the big, beautiful bill, and as well take any questions at the end as long as we have some time. I'm going to let Robert primarily drive on this, as he's more the tax expert with us. I've got more of the estate stuff and insurance stuff that I like to be more polished up on. So we're gonna go over this today. We'll be as quick as we can, but don't hesitate to raise your hand or whatnot if you have a question. We'll probably keep moving to finish a point, and then we'll jump into the question if we see you. Hopefully, we won't miss you. But go ahead, Robert. I'll let you take it away
Awesome.
as Dr. Robert Hill, since
Oh,
you're
I didn't wear
doing
my glasses today.
this. Tragic. That is tragic.
All right. Sounds good. I'm gonna share a really advanced slide deck that I promise I did not put together 5 seconds ago. That's probably not the best view. I'll just do it like this. All right, can y'all see my screen? Good? Yeah? Okay, thumbs up. Okay, One Big Beautiful Bill Act enacted a couple of weeks ago. Lots of changes. We just wanted to do a quick overview to kind of let you guys get your arms around what's happening. We're going to do this kind of in three very high level pieces. One is stuff that impacts individuals now. One is stuff that's going to be impacting individuals in 2026 and beyond. And then lastly, maybe TMI for some of y'all, but stuff that's going to impact businesses as well, in case you have dreams of starting a small business. There were a lot of changes. And I think if I were to comment on the high level overview of the changes, I would say there's really just a lot of nuance to a lot of this. Some people will see some benefits, others won't. Um, it's just very nuanced. So I'll try to call out things that are maybe more common to everybody when we get there. And without further ado, let's jump right in. Okay, first off, like I said, we're going to talk about stuff that changes for individuals. And these are just kind of like the big talking points. Um, there's a little bit more, and feel free to reach out if you guys have questions for clarity later. Love to help you with that. So stuff that's going to affect your taxes in 2025. First off is the increased standard deduction. So the TCJA increased standard deduction is made permanent now and is adjusted to inflation. So back in, I think it was 2017, there was a bump up, and that was set to expire. And the One Big Beautiful Bill Act basically made that permanent. Now, when we say permanent with all of this, please hear me doing air quotes, because with each new political party that comes in power, they absolutely in the past have changed permanent things multiple times. But I would hear in current law unless subject to change in the future. So I personally like the increased standard deduction. I think it makes it a lot easier to just maybe have a lower likelihood of having to itemize and carry out all the receipts and everything. But yeah, so the standard deduction is now 15,750 for individuals, 23,625 for head of households, and 31,500 for married individuals filing jointly. And so that's just right off the top. If your adjusted gross income is 100,000, then you're married, you get another 31,500 that you get to take off that before you're paying before that's considered taxable income. That's a big one. The second one that may influence more people is the state and local tax deduction. You may have heard about this in the news being called the SALT deduction. Most people weren't aware that this was in the tax law for a long time. It was just the limit was $10,000. And so I was more familiar with this when I was in the state of Texas because there was no income tax. And so you look at other things. So what I used to do in TurboTax is go, hey, there's a formula that adds up my sales tax estimated, and then you add up all these things, and that's an increased deduction up to that $10,000 limit. Here in North Carolina, if you live here, you may be adding up, your state income tax and various other local things. The bottom line, now there's a higher cap. So if you're in certain states, this may benefit you more. But if you have high state and local taxes, you can now deduct more of them up to a $40,000 limit. So that in general is a good thing. However, if the deduction is reduced by 30% of a modified adjusted gross income. So think like basically what you make after 401k deductions and a couple other things. Once that goes over $500,000, it gets reduced back down to that old $10,000 level. So for many people, they can just hear, now I can deduct up to $40,000 of state and local taxes, but there are phase outs. And that's true for many of these things. Wow, I've gotten through two and I'm already falling asleep. Aren't taxes fascinating? I'm going to try to make this as interesting as I can, but please be gentle. The subject matter is just not that good. Okay, third is the senior exemption. So there's now a $6,000 between the lines deduction for taxpayers 65 and older that can be claimed until the year 2028. In the news, this was often referred to as Social Security having a deduction. That was a bit of a misnomer. They're kind of on average doing the math and saying, oh, the average person's going to get a deduction if they're claiming Social Security because they're over 65, yada, yada, yada. What I'm telling my mom is, hey, mom, you're over 65. And so as long as your income is below the phase out range, you get an extra $6,000 deduction until the year 2028. So, like the SALT deduction, this also goes away or gets phased out once your income exceeds a certain amount. This amount is lower. It's $75,000 for single people. So once you go above that, the deductions starts phasing out. And then for married filing jointly, it's $150,000 is when it starts phasing out. And there's different phase out ranges. So it's basically for a single between 75 to $175,000. That's your phase out range. That's when that deduction the math goes down. And for married filing jointly, it's $150,000 to $250,000 adjusted gross income. That kind of goes away. So if you're under those limits, you just get an extra deduction. So that's a good thing. And a lot of these are kind of that ilk. We're seeing in certain circumstances, you're seeing increased deduction potential. It's just, does it apply to your situation? It just kind of depends. Okay, the next one, deduction for tips and overtime pay. This is another temporary one. So for tips, for qualified tips, that's for occupations that customarily receive them. Think waiters, waitresses, things of that nature. Now $25,000 of qualified tips are deducted, and $12,500 of overtime pay for single individuals, $25,000 of overtime pay for married individuals can be deducted. Great. Your payroll will probably identify all of that for you. If you do receive cash tips, you're still required to disclose those. And both of those deductions phase out for single people with modified adjusted gross income. I'm going to start calling it MAGI for short. If that MAGI is over 150,000 for single and over $300,000 for married filing jointly individuals or families. And the senior exemption phase out in 2028. This overtime phases out or goes away in 2029. So while these are in law, these two so far that we've talked about are temporary. Okay, we just got three more for this 2025 time period. I've got some kiddos, so I was excited to hear about this one. The child tax credit is increasing. This is now a partially non-refundable tax credit. Refundable tax credits have to do with if you owe money at the end of the year. If it's non-refundable, can't claim it. If it's refundable, you can, essentially. So this is a partially non-refundable. There's a formula to adjust amounts, but what you need to know is The credit is increased to $2,200 per child, and then it's finally going to be adjusted for inflation years later. My wife has her, this is nerd moment in the Hill family. She has her doctorate in public policy. And I could tell you one of the many late night rants that I hear about how messed up our policy situation is in the United States is why are we not indexing things for inflation in the US tax code? The One Big Beautiful Bill Act did make some progress on indexing more things that go up for inflation. So I think that's generally a sensible thing to do. This is one of those areas. So of that $2,200, $1,400 of it is the refundable part. I think more likely to receive it. And now that's made permanent and adjusted for inflation. And the $500 non-refundable credit for dependents other than qualifying children is also made permanent. Again, a lot of nuances, but just here for many people, child tax credit slightly went up. Okay, 5 to 9 plans. We love 5 to 9 plans at Cardinal Hill for education planning. The big picture here is that in general, what qualifies as an expense has gotten to be a little bit more broad. So qualified expenses now include post-secondary credentialing expenses. More expenses will be added to the list of elementary and secondary school qualified expenses in 2026, such as materials and books, as well as tuition for tutoring and education classes outside of the home. So again, a 529 plan is similar to the intuition of a Roth IRA. It grows tax-free, and now what you can use it for is a little bit more broad. So we love the trade, so little Johnny going to become a plumber and electrician, and one of the benefits of this new law is that little Johnny can maybe pay for his certification exams and those expenses out of 529 funds should little Johnny not go to a four-year university. Lots of good opportunities there. Okay, lastly, car loan interest deduction. So interest paid on a qualified passenger vehicle, new loan will be deductible until the year 2028. So the deduction is limited to $10,000 per year and only applies to personal vehicles that had their final assembly in the US. So I think that's one of those situations where you're going to want to look at each vehicle, devil's in the details on making sure that it qualifies, but it could be an interesting slight nudge more towards financing. Again, interest rates a bigger factor potentially there. Okay, that's all of the stuff that's live happening in the year 2025. Hopefully that makes sense. We'll definitely have time at the end for questions. So I'm going to move on to slide number 2. Okay, individual tax provisions starting in the year 2026. There's a lot of cool stuff in here. It gets me a little bit more excited, to be honest. And we'll start right with one of the big kahunas in our mind, which is the estate tax exemption. So back in the day, the estate tax limitation or exemption was raised from 5 million bucks to 10 million bucks, and then was adjusted for inflation. So if you kick the bucket and you're single, this is the amount that you can pass on to heirs essentially without having to pay estate taxes, which can be a beat down like 40%. If you're married filing jointly, you get both of those limits. And this year, it had been temporary set to expire, and it was all the way up to about 27, 28 million bucks. The One Big Beautiful Bill Act essentially made that permanent. And so now each person gets a $15 million estate tax exemption. So if you're married, that's 30 million bucks. And then it's going to be indexed for inflation going up. So this is a pretty big impact to estate planning. We've been speaking with multiple attorneys, and in general, one of the intuitions you can have is with estate planning, there's kind of been historically a tension between income tax planning or tax benefits now versus estate planning or tax benefits later. This gives you more wiggle room theoretically that estate tax in the future. And so maybe some of the more tax planning strategies to benefit now become more attractive. So we absolutely factor this into each of your financial plans when we're evaluating. And there still can be really great reasons to, for example, have a trust that goes beyond just estate tax avoidance. But this is a pretty good thing, maybe a little bit of a breathe easy in terms of avoiding estate tax because of that. Okay, second thing is tax rates. We already spoke to it, but just to be super clear, the tax rates introduced by the Tax Cuts and Jobs Act, or the TCJA, in 2017, those were made permanent, and now there's slight upward adjustments made to the top of the 10 and 12% brackets. So in general, for most taxpayers, this is a big win. It was one of those like silent benefits that most people weren't realizing tax rates were maybe going to be adjusted in a way that wouldn't benefit them had this bill not been introduced. But now that this has made those tax adjustments permanent, this can help a lot of people. Okay, next up, home mortgage interest deduction. So we're just going to call the One Big Beautiful Bill Act the OBA for short. The OBA permanently extends the limitation on deducting qualified residence interest to the first $750,000 of home mortgage acquisition debt. It used to be $1 million, and it treats certain mortgage insurance premiums on acquisition indebtedness as qualified resident interests. It also confirms the inability to deduct interest on home equity loans. So basically, there's some slight tweaks to what you can deduct for interest. In general, this applies if you have a house that's worth a whole lot of money and you're carrying a sizable mortgage. We will definitely chat with you more if this applies to you. But in essence, I think the making this permanent just kind of resolves some of the policy uncertainty for planning for buying a house and financing versus paying cash, that kind of a decision. Okay, charitable contributions. Cardinal Hill, we love the idea if you're charitably inclined to try to help somebody else out, and we love the idea of benefiting on taxes if you do that. So a new above the line deduction is available for taxpayers who use the standard deduction. So if you remember, now in 2025, increased standard deduction, so maybe more people are going to do that. Well, what this does is it introduces $1,000 extra for single taxpayers, $2,000 extra for married that claim the standard deduction. So you can donate if you're married, $2,000, get a deduction on top of the standard deduction. So that's just a good thing. If you itemize, however, there's a new limitation. Charitable contributions have to exceed 0.5% of a taxpayer's contribution base to be deductible. Pretty nuanced situation where that wouldn't happen. But yeah, just a little bit more nuance with charitable contributions. High level intuition I'm taking away is if you're doing the standard deduction, maybe keep some receipts for up to that $1,000 or $2,000 limit so that you can get that extra juice on your taxes. Okay, itemized deductions. The P's limitation is removed. I'm sure all of you are kept up all night about that. However, a new limitation has been introduced for 2026. The amount that an individual taxpayer can deduct must be reduced by 2/37 of the lesser of the total amount of itemized deductions, number one, or two, so much of the taxpayer's taxable income for the year as it exceeds the dollar amount at which the 37% tax bracket begins with respect to the taxpayer. I'm sorry I had to say that out loud, but the nuance here is there's a little bit. If you're doing TurboTax, all this is going to be baked in. If you're working with the CPA, they're going to help you with limitations on your itemized deductions. A lot of very high tax bracket individuals were using different write-off methods, and now there's a little bit more of a formulaic approach to limiting the total amount you can itemize. I don't think it's worth our time for me to explain the 2/37 rule in great detail. Happy to talk to you on offline about that. Okay, miscellaneous itemized deductions. These are now permanently eliminated except for unreimbursed employee expenses for eligible educators, teachers. The miscellaneous field, as I understand it, from talking with CPAs was just kind of a nightmare for audit risk, and people were putting all sorts of crazy things in there, deducting their jet skis and whatnot. And now basically the IRS is just saying the only eligible category for that is where a teacher has qualifying expenses that they didn't write off anywhere else. That's allowed. Everything else is gone. Okay, qualified business income deduction. The QBI deduction is something that I think anybody thinking about starting a small business needs to understand. Basically, you want to think about the portion of your income from that small business that is your distribution of profits. The QBI deduction basically is 20% of those profits is a tax write-off. It's pretty sweet. However, there were phase outs of if you made so much money, that QBI deduction went poof. So what the One Big Beautiful Bill Act does is it makes the QBI deduction permanent, and it increases the phase outs for a specified service or trade business. Think of financial advisor, lawyer, people whose job is to provide advice. Any business like that has a phase out to $75,000 for single people and $150,000 if you're married filing jointly. There's also an inflation adjusted minimum deduction of $400 if you have at least $1,000 of QBI, qualified business income, in which they materially participate in the business. So I think if I were you, if I was walking away from this, if you're thinking of like a startup or a side business or something like that, you want to be aware that, hey, some of that income is going to result in an additional deduction, and now it's a permanent, and there's some limits to it. That's what I'd be walking away with that one. Okay, alternative minimum tax. This is a real bogey that typically only applies to people in certain situations if there's either a lot of money that they're making or if they have like a really big sale of a business or land or whatever. Basically, alternative minimum tax is this sneaky secondary tax code that's always working. So you got your regular 1040 statement over here, and then there's this alternative minimum tax. And as long as your regular tax is higher than the alternative minimum tax, which most people it is, then you pay whatever TurboTax says. But if you sell a business or sell a piece of land or do individual stock options and exercise those, or a number of other kind of nuanced situations, this alternative minimum tax can bite you. And so basically what the OBIT did is it increased the exemptions for the alternative minimum tax introduced by the TCJA, but it reduced the threshold at which the exemptions start to $1 million. It's pretty complicated to explain alternative minimum tax and the actual formulas behind it. But I would just say if there's a year where you're exercising a lot of individual stock options, you sell a big piece of land or a business or something like that, or there's any of these other strange years where there's a high change to your income, just make sure that we know about it so that we can evaluate your risk for alternative minimum tax and then talk about trade-offs of different strategies to manage that. Okay, almost done with this piece. The last is the ABLE accounts. Not a lot of people use those, education planning account, but basically the contribution limits to ABLE accounts are increased, and the ability to roll over 5 to 9 funds into an ABLE account are made permanent and will be adjusted for inflation. Jesse and I usually don't like those very much for most people's plans, and so that's why we haven't talked to you about it, but if you're curious, happy to discuss. And then lastly, the Trump accounts. We've been getting a lot of questions about this. So essentially what these Trump accounts are is the OBA created like a special type of IRA for kids under the age of 18. So contributions to this type of IRA can only be made in calendar years before the beneficiary reaches the age of 18 and are limited to $5,000 per year, adjusted for inflation after 2027. So that's what money is going in. Money coming out, the distributions, they can begin in the calendar year when they reach 18, the beneficiary. The distribution of those funds are the basis of those funds is tax-free, while the distributions of income will be treated as IRA distributions, and they're subject to ordinary income tax as well as a 10% penalty if it's before age 59 and a half, with some exceptions. There's additionally, and this is what's in the news, a lot of people are interested in this, $1,000 tax credit, this is like the free money, is being offered for opening a Trump account for a child born between the years 2025 and 2028. So you're going to want to be aware of this for grandkids or kids born in that 4-year window. The bill also allows for employer contributions to these Trump accounts. Doesn't mean your employer is going to do it. It just gives the legal chassis to make that available. You could ask your company and HR department about it. The contributions will not be included in the employee's income for tax purposes. And then lastly, what can you invest it in? What can the money be invested in? Investment options for the account appear limited to mutual funds and ETFs that track the S&P 500 or another qualified index. So in my mind, this is similar to the investment selection for 529 funds and things of the like, but this one is still being built out in terms of how it's done. So a lot of tax law loves to be announced and everybody in the news talks about it. And then when people say, well, how do I do this? A lot of wait and see. So that's kind of the Trump account. Okay, 2 down, 1 to go. I'm going to go through these a little bit more quickly, not because I don't think that they're interesting, but because these only influence business owners. But if that is you, please reach out and we can unpack this a lot more. Okay, first off, bonus depreciation. That's accelerating your depreciation schedule. The OBA permanently returns bonus depreciation to 100% for property acquired and placed in service on or after January 19th of 2025. So you may not elect this, but if you do, it gives you more framework to just write it off immediately. The second is special depreciation allowance for qualified property reduction property. The bill allows for an additional first-year depreciation deduction equal to 100% of the basis of qualified production property, which is generally non-resident real property used in manufacturing and construction in place after January 19th, 2025 and before January 1st, 2029. So the property must be placed in service by January 1st, 2031. So again, more depreciation for, I see this personally as a way to incentivize more domestic manufacturing, local business, property investment, things of that nature. All right, Section 179 expensing. The OBA increases the amount taxpayers can expense to 2.5 million per year. And if the cost of qualifying property exceeds 4 million, the deduction is reduced by the excess amount. So in general, this is a part of the tax code that allows you to write off, purchases in an immediate time frame rather than depreciating it over multiple years. Again, kind of incentivizing investment and spending money. The full expensing of R&D or research and development expenses. The OBA permits taxpayers to deduct domestic R&D expenses paid or incurred immediately. In contrast, expenditures on research that's conducted outside the US must still be deducted over 15 years. So if you have a business in like software or a lot of the stuff in RTP with CROs or things like that, and it's considered R&D, this is a nudge towards making sure that's coded as happening inside the United States. Some of y'all may have seen the stuff lately about H-1B visas. I mean, this is all kind of tying in with trying to incentivize more economic activity occurring on US soil for the purposes of innovation. Okay, lastly, qualified small business stock exclusion. This is a great part of the tax code called the 1202. For qualified small business stock that is acquired after the enactment of this bill, the exclusion is subject to a new tiered system. Essentially, let me take a step back. If you're normally, we're going to say, hey, consider being taxed as an S corp if you're a small business, so that you can separate wages from your distribution of profit, and that's what's called a flow-through entity. If you're a C corp, the problem with that is double taxation. First, C corps pay their own taxes, and then if you're the owner, money flows through to you. You got to pay taxes on it again. So most of the time for small business owners, we're like, consider the S corp. The qualified small business stock exclusion is one of those big reasons to consider the C corp, because at a high level, if you start this company and it's a qualified industry and you do everything right, you could sell that business and potentially, it used to be, get $10 million exempt from taxes. So you can have this great future goal of tax-free business planning. So now that I've said all that, the new limit for the qualifying period of how long you have to hold that stock, aka your runway to start this company, in my mind, is 50% if it's held for 3 years of a write-off, 75% exclusion for 4 years, and 100% if it's held for 5 years or more. And the asset limit for qualified small business stock is increased to 75 million, and the exclusion amount is increased to 15 million. So it used to be you could harvest 10 million bucks of tax-free exit value. Now it's 15. And it used to be the limit, I forget the size, it may be $50 million. Now it's 75. So we're allowing more domestic entrepreneurship to have this tasty carrot of a tax-free harvest, which I think is a good thing personally. Very pro incentivizing local entrepreneurship. Okay, so all the stuff so far is 2025. This last one is in 2026 and later. And then that is charitable contribution deductions for corporations. And the change is basically a floor is applied to the corporation, which is 1% of the corporation's taxable income. And the charitable contribution deduction can't exceed 10% of the taxable income limitation. So you got to do at least 1%. Maybe that's a good thing, motivating companies to give more, and they can't write off more than 10. Maybe that's a way to prevent shenanigans with dodging taxes. Okay, that was a lot. We talked about individual changes to the tax code in 2025, individual changes to the tax code in 2026 and beyond, and the major provisions to businesses, most of this is small businesses in my mind, to 2025, and then this one in 2026. So with that, I'm now going to pause and see what questions anybody has. So if you have a question, if you're still awake, I apologize. Taxes aren't fascinating. Feel free to raise your hand and we will unmute you. All right, Kyle, I see you. I don't see how to unmute Kyle. Sam, could you help with that? It's grayed out for me.
It let me do it.
Sweet.
Okay.
So just had a question on that senior
Mm-hmm.
deduction. So is that for married filing jointly, do both members have to be over 65, or is it just one over 65? How do they do that?
Good question. Kyle, I don't know.
Yeah.
Okay.
I guess you'll find out for it.
We absolutely will. We use a lot of stuff that's like heavily compliant.
Hey, what was it? What was the
I
question
don't-
again? I'm so sorry. I was reading
It's
another point.
Do both. So in other words, I'm not going to say their ages, but let's say Kyle was over 65 and Aaron wasn't. Can they claim the deduction? I believe the answer is yes. We will confirm that with you. Because you're married filing jointly, the IRS kind of considers you like a package deal. And
Right.
so I believe that OBA is saying if one of the two is above, your package deal is triggered, and so you're good. I'm wondering if both are over, if it's doubling it to 12 in your case. So I'm wondering if it's 6 and 6. Does that make sense?
Right.
And I think that's the case, but if you're asking, do you miss out on anything unless both of you are over? I think I'm pretty confident to say the answer is no to that. I think you at minimum would get the 6, and then if both of you go above 65, you get the 12.
Okay,
But I will follow up with you on that.
great, thanks.
Right. What other questions do we have out there? Okay, Alan, can you unmute yourself, bro? Or do I have to do it, or maybe Sam does? I'm blocked. Apologies. Alan, looks like you have to unmute yourself. Can you like hover your mouse over the little gray bar and like hit those 3 dots? Hmm. I'm not seeing it. Kyle, did you just click your name or what? How'd you unmute yourself?
Yeah, I just clicked on the mic up at the top and unmuted.
Clicked on the mic up at the top.
Yeah.
Yeah, 2 over from the leave button.
Okay. Alan may have stepped away
Hi.
for a second anyway. Oh, there you go. Hey, Al.
Hey, you kept mentioning TurboTax.
Mhm.
I'm inclined to think I need a CPA, but I've never had a CPA. But we've used TurboTax for years, but is this too complicated for TurboTax?
Yeah, I can't speak for their software or others like it. And when I say TurboTax, I'm doing hand waving to all the kind of,
Generic. All right.
software. But
Lower T.
what I do know is that typically these pieces of software implement known and current law very well. They may not always have the tool tips to make sure that you claim the extra $2,000 charitable deduction married filing jointly if you do standard deduction. So what you can do is say, hey, what did I hear today that I think is particularly relevant for my situation? Maybe it's that one, for example, or something else. And then if you're doing TurboTax, I would spend an extra 5 minutes just to double check that you've actually entered the data. And then what I have personally done in the past is in those years where I'm a little bit unsure, I've paid the extra, whatever it is, $50 to get one of their little help people on the line. And I ask them, hey, here's my 5 laundry list of questions. Can you see that I've done everything right? So we're not a product sponsor of them. I can't like say for sure what they're doing. But I will say also some of the tax strategies that we implement, we recommend people start working with the CPA at some point. One of the strategies is like Roth conversions. There's a couple more. TurboTax can handle them. It's just we've seen some of our clients have challenge like entering those forms correctly. It can be a little nuanced. So in general, if you want to talk about it more for what problem you're trying to solve, let us know. We're happy to refer to a CPA if that's relevant for your situation. But my personal experience with TurboTax is they have implemented all known tax law changes very well. I've just had to make sure that I enter the right data. So that's the only risk, in my opinion.
Thank you.
Mhm. Okay. Anybody else? Why don't we open it up to a little bit more broad about taxes in general? I know we're talking just about the OBA today, but if there's parts of the tax law that just don't really make sense to y'all, like how it works, um, happy to open it up to just kind of questions. One of the things that I want to make sure people understand is this idea of like marginal tax bracket. I've heard people over the years say, well, I don't want to make more money because then I'll get pushed into a higher bracket and I'll lose money. That's a bad takeaway message. Always make more money. It's the percent on the next dollar that gets taxed. So if you were in the 10% bracket, first money in that bracket gets charged 10% against it. If you get bumped to the next bracket and you make an extra 10,000 bucks, that 10,000 bucks gets charged 12%. The first part of your money still gets charged 10%. So you're still going to be making more money. It's just a progressive tax code to where the next amount you make gets charged a higher amount. There are some nuances to that situation with like government benefit cliffs and things like that. But in general, if you have the opportunity to make more money, it's still a really good idea to do that. But if there's any other questions like that that you want to ask, or just kind of high level questions about taxes in general, happy to take a stab. Yeah, go for it, Mary. I think you just gotta, oh, you're unmuted. Yep, go for it. Mary, you're unmuted, but we can't hear you, so I don't know if your speaker or mic is working or whatever. All right, well, Mary's trying to get that working. If anybody else has a question, just feel free to unmute yourself and ask. We're happy to stick around as long as you guys would like.
All right. Well, I'm going to go ahead and end it for everybody. If you want to stay on, feel free. Thank y'all so much for coming.